Hello, everybody. Joe Lucey here, Secured Retirement Financial. If somebody attending could just put a little something in the messaging there that you can hear me loud and clear, and no audio. Dave, were you able to hear me? Sometimes Galen, if she has no audio, maybe it's just on her end. Yes, we can hear you. Okay, thank you, Amanda. So, we've been doing these once a week, basically going back to March 23rd, just as we were starting off with all this coronavirus craziness and what have you. And back on the 23rd of March, the Dow Jones was at 18,500. Today, we are closer to 24,500, up almost 30%. So with that said, we've been doing these once a week, trying to keep these to about 15 minutes. I'm a little lengthy. Sometimes we go maybe to 20, but I promise you today we're going to keep it to 15 minutes. I got a lot to cover. And basically what we're going to be focused on here today is really what are the three things you must know if you end up retiring unexpectedly. With that said, I think that even if you are already retired, maybe not so concerned about retiring yourself unexpectedly, I think there's going to be a lot of good information here for everybody. So we had that. Another housekeeping item. One thing that we are looking at doing is I'm trying to kind of come up with some kind of catchy name for these 15-minute webinars every noon on Monday. I don't know if we're going to call it Monday's markets or market updates, or cup of Joe with Joe or something like that. But if you have any great ideas on what you think we could label these 15-minute webinars that we're going to be doing, and we're going to continue to do because we've had such a tremendous feedback, I would love to hear your ideas. So if you want to, you can type those in or what have you, or after the visit, just feel free to give us a call or what have you, email us. So anyways, with that said, let's jump right into it. Here's the the required disclaimer. I'm not an attorney. We do a lot of tax planning here. I am a certified financial planner, but I'm not a CPA. We can't legally interpret tax code, but we do our certified financial planners, and with that, we do a lot around tax planning, estate planning, and just overall making sure that we are helping families creating a comprehensive retirement plan, one that incorporates investments and income and taxes. Strong believers here that wealth management is different than necessarily what we do. While important, it's a piece of the step. Making sure that you have a plan in place around taxes and income is also very important. So we'll kind of get into that today. Lots of headlines going around. I clipped this off this morning. Oil's plunge again. Oil stocks are surprisingly resilient. Here's the thing. It sounds like they're pretty much out of any storage. So the U.S. has announced that they're going to be cutting back on some of their production. We'll kind of see where things go. I think that oil prices, until we start getting away from some of the shelter in placing and what have you, are going to probably be in a situation. Some of this was brought on by these feuds going on between Saudi Arabia and Russia, and well, now we're going to start seeing that. So anyways, that's some negative news we're seeing. We also got Boeing saying it's going to be absolutely years before they can return to travel like we once had. With that said, we're coming into a very lot of headlines this week are going to be around earnings, and maybe some of the other things are about how some states are starting to ease the coronavirus restrictions. We've got states like Colorado and Georgia, and there's a half a dozen of them that are really starting to open up a little bit. And, hopefully Minnesota here, we're not too far far behind that. I'm optimistic that we've kind of seen the worst and we're going to be going better. But, we got to make sure that we're doing it the right way, too. With that said, keep in mind that the stock market itself has always been a forward indicator. It's forward looking. When the markets, when things are getting scariest, when there's unemployment and when the coronavirus, when the number of hospitalizations and the deaths continue, we've probably going to see the markets recover and continue to do better than the overall economy. So even if we go into a several month recession here, which undoubtedly we won't, we will probably continue to see the markets doing some recovery. And I've got a slide that shows that here in a second. Here's kind of the big news. We've got just a tremendous amount of unemployment here. March 21st, we had 3.3 million layoffs. It got to this just under 6 million here, or in the sixes for a few weeks in a row, and then last week. So now we're sitting at about 26 million folks unemployed. They're saying that this could get into the 20% range, and so I guess that's what I saw, and decided that maybe we should have a discussion on what to do if you find yourself unexpectedly retired. They tell us that 50% of all Americans will end up retiring somewhat unexpectedly. Those are numbers going back before the whole coronavirus contagion stuff here. We probably are going to see that number, that 50%. I mean, we could see quite a bit more of families retiring unexpectedly, and I think that while many of us are optimistic that maybe this has been a furlough, we may see something worse. So anyways, that's kind of the topic we're going to go over today. Promise not to take too much time. Here's a good indicator of where the markets have been. When I first started these back on March 23rd, as I said a little while ago, we were at 18,500 on the Dow. This is the S&P 500 here. But we're up almost 30% from the bottoms. Are we going to get back? Are we seeing the worst? Who knows? I think as we start to see some of the shelter in place is kind of becoming a little bit, as they're relaxing some of that. If that goes well, I think that we could see ourselves continuing to go trending kind of higher here. With that said, wouldn't be surprised to see us have some kind of setback. Hopefully that's not the case. But I think the real next question then is, if we do, where are we at? So if I'm planning for retirement here today, or maybe I found myself unemployed, what are some of those things that we should be looking at? That's what today's all about. Number one, let's take a look that we are maintaining a diversified asset allocation. Now, asset allocation is different than diversification. So diversification is when I start looking at having all of my money in Wall Street type assets, stocks, bonds, mutual funds. And maybe it's by having some fixed income, buying some bonds, buying some treasuries, maybe even buying some municipal bonds, buying that with my larger companies, buying it with some smaller companies. Let's get a little bit of global in there. That's diversification. What we're really talking about here is making sure that we are fully having asset allocation. By being properly asset allocated, they tell us that 96% of our overall returns in the market are going to come through asset allocation. It means that we have to have some money that's protected. We want to have some money that's exposed to market risk, and maybe we want to even have some assets that can have some downside to them, but don't necessarily follow what the S&P 500 is. A good example of that might be my real estate. By buying some real estate, bringing that into the portfolio, putting some maybe some of these precious metals, things like oil and gas investments, even with the levels that they're at here. But buying maybe a little bit of gold or some palladium, something like that. By bringing some of those other investments in there, we can also have a statistical lower risk with our portfolio and get a better rate of return. With that said, one rule of thumb: we never, ever want to have money exposed to the whims of Wall Street if I need to take money out. I brought this up the last couple of weeks. I had another call just this week. A client of ours calls us up and says, Joe, we need to take some money out of our accounts. We're afraid to do so because the markets are so low. We are looking for ways that we can help families get the income that they need without taking money out of an account that's still down, 15% or so from the peaks. Let's find some better ways to do that. Best way to do that is to be planning ahead. If you're in a position right now, we had a client of ours, Todd, that called us up, said he had some real estate that he sold, wanted to know how to best manage investing into the markets now. First thing we did is we looked at this. Do we think the markets are going up, down, or flat? By then looking at that, we said, how much money do we need to take out of the of the account. In Todd's case, he probably is several years away from having to touch this money. We decided to put most of the money into Wall Street type investments. With that said, somebody comes and sits down with us, says that they are concerned that they may need to take some withdrawals. Let's, if we see the markets pull back again, we want to make sure that there's some protection in there. So really the first step of making sure that if you find yourself unexpectedly retired or maybe just already retired and want to make sure that you are having a good plan in place, let's start by making sure we look at the asset allocations. That's something we do here at Secured Retirement Financial. If you've got questions on which we should be doing with your own situation, give us a call. Let's schedule 15 minutes, whether you're a client or not, and kind of show you how we do that. Keep in mind, most clients hire us here at Secure Retirement Financial. Their primary goal is to make sure that they've always got the income they need. Number two, they want to make sure that they are reducing their taxes, their tax footprint. And then the third thing is grow the wealth, but let's never do that at the expense of potentially not being able to maintain our lifestyle income or being able to put ourselves in a better situation tax-wise. So that's an area we can sit down and explore with you. Let's talk about the second step. Let's start to get excited about taxes here. I'll tell you, I think that right now we are in the best situation in over 40 years. I've been saying it for a while. I've been saying that we are in a situation with the new Trump tax plans to really start to get untaxed from some of this money we've been setting aside in our retirement accounts. And now that the markets have pulled back, I can even move more money at a tax advantage. Something that was worth $100,000 is now worth $80,000. I can move that money. If it recovers back to 100, I'm going to get that back. The biggest lie we've been told as boomers is this: you're going to put aside money into a retirement account, and then when you take it out, you're going to be in a lower bracket than when you put it in. Look at our taxes right now. Today, we are probably in the lowest bracket we've seen going back to World War II. That's the good news. The bad news is this: I don't think with $3 trillion in stimulus and more on the way that we're going to be able to stay down here. Here is the golden opportunity. We want to help families get untaxed here by not paying attention to taxes. It's the fastest way that I know that you can get caught up in a situation where your money is going to be worth less. I believe that over time, when we start looking out 10 years, 15 years, our tax rates are going to be higher, and it's going to be one of the biggest areas of inflation. Now is an opportune time to start to get untaxed. Now, with that said, I'm talking about tax planning here. I'm not talking about tax preparation, although we do that with our clients here. We have tax experts here. I'm talking about looking forward. How do I get this money that's going to be taxed down the road? Keep in mind, as a married filing joint couple, if you are married, you're in a lower bracket than when there's a surviving spouse. We call that the widow's penalty. We got to be careful. The widow's penalties and the kiddos penalties, when the kids inherit this money, they pay our tax for them. Tax planning is something that it makes a whole lot of sense. If you want to schedule some time to review your current tax plan with us, or maybe you're thinking about your own situation and you realize you haven't really been doing a lot around taxes, I'm telling you, now is an opportunity with everything going on to really put ourselves in a better situation long term. Third area I wanted to discuss, we're covering here today on, we're going to call this, I had somebody come up with a really good one, Joe's Monday Huddle. So we're going to call it, thanks, Steve, Joe's Monday Huddles. We're talking about the 3 things that you can be doing if you find yourself unexpectedly retired. However, maybe you've been retired for a while. These are 3 things everybody wants to keep in mind as we look at their overall planning. A lot of times what we find is that the strategies that we're used to getting ready for retirement, the accumulation stage, a lot of focus on the wealth accumulation only. As you transition to retirement, or if you're in a situation right now where you're concerned about the direction of where things are going, I know half of you are probably concerned that the coronavirus is going to come back and it's going to be worse next time. So we're worried the markets are coming down. The other half of us are just kind of tired of being shelter in place and looking to get out and about and start to socialize again. Whatever camp you're in, you want to be looking at these 3 areas. Number 1, making sure we have true asset allocation. Number 2, looking at taxes. And then the other area is I want to start thinking about my mailbox income. Mailbox income is money that hits the checkbook each and every month. It's money that's going to be in that checking account regardless of what's going on in Wall Street, whether coronavirus comes back and gets worse, or we have seen the end of it. Families that have more mailbox income, I'm talking about money like Social Security, money like pensions. Only about 20% of us are going to have a pension, but let's make sure we're getting that piece right. They tell us this: 80% of all families retire without a written income plan. 80% of families are going to go into retirement knowing that they're going to have to take money from their savings. This money has to last them a lifetime, and nobody has taken the time to help them decide which of their monies to spend from first. Should I take from my IRAs right away? Or should I take from Social Security and let the IRAs cook a little longer? Or do I take it from the IRAs, letting my Social Security? I mean, there's a lot of different decisions there. When you're working with one of the advisors here at Secured Retirement Financial, I want to make sure that everybody understands what their mailbox income is going to come from. They have a written plan, and the reason why we do this, MetLife, with Sun Life Financial tells us that 63% of people that have a written plan worry less about their money because they have the planning in place. 73% of families that have a written plan believe that financial planning has helped them, give them peace of mind. That's why families are looking for when they're retiring. And you're twice as more likely to be confident in the plans when they retire, when they have a plan. So if you are unsure what that income plan looks like, if you want to see how to put together a look forward tax plan and make sure that you have your portfolio, that's what we can do here for you. I know a lot of you are listening to us are currently clients. If we want to review this, take advantage of a 15-minute strategy session. As George Foreman said, having an income plan is important. It's not the question of what age you want to retire, but at what income. Taking that income plan, making sure I can maintain my lifestyle and do so in a tax efficient way is important. That's the second thing we talked about and making sure that we can take this money back and spend in confidence, making sure we have a true asset allocation. All three areas of importance. I'm pulling this up because Michael Pollack is a Wall Street Journal journalist. He's an author for the Wall Street Journal. Brought me up. It was nice of him. He gave me a call here a couple weeks ago, asked me for a quote, what I thought about what was going on. If you want to pull this up yourself, it was published on April 20th. It's tips for tweaking your retirement account after a sell-off. And basically, he quoted me by saying that you want to make sure you're thinking twice about the investments and the equities. Historically, stocks have performed more strong after a large downturn than others. This was something I was quoted here closer to the first part of April. It took a couple weeks to get that out, and I guess that's short term. We've been right, but here's the thing: you need to make sure that you're feeling comfortable about your retirement, having that plan in place so that you can have that peace of mind. The 73% of families that have the retirement plan. What's the next step? What's the first step? Well, if you're a current client of ours, you know that it's an open door policy. Please don't ever hesitate to call. If you are not a current client of ours, I encourage you to schedule a 15-minute strategy session today. The idea behind this is just 15 minutes with one of the advisors here to put together an action step that you can take right now to make a significant difference in your retirement planning. I have, and you should see this on the bottom of your screen now, a offer. If you click on that right now, we will make sure that we get you scheduled on the calendar with one of our advisors here. Take this 15 minutes. It's the first step of making sure that you have a plan in place, what we call a tax smart retirement program. Process is always the same. It starts with that 15 minutes. We start looking at your current situation. Most of these, not most of these, all of these for the last month and a half have been done virtually. And I'll tell you, I don't know, I think there are some things around doing the virtual meetings that I think we might kind of hold on to. I think a lot of families really kind of like the idea of knowing that they don't have to necessarily drive across town to visit with us. With that said, we take the 15 minutes. If after that 15 minutes, we can identify the number one action step you can take today, That's the idea behind it. Help you get that planning in place, help you put that together. There's some other ways that you can reach us here on this slide here. So if you have anything else, that's great. I promised you today I would try to keep this to just 15 minutes. It looks like I went over by a couple. Probably had to get rid of one of those slides up front. But with that said, we're here for you. If you have questions, whether or not you're a current client of ours, don't hesitate to click the box there. Get on the calendar. Let's schedule some time. With that said, we will be back with more of my Monday's Huddle, Joe's Monday's Huddle, right? Something like that, Steve. Anyways, everybody, enjoy the rest of your week, and we're here for you if you need it. Have a great day.